In real estate investing, timing is often everything. Real estate is nothing like the stock market, which is very liquid, and as such, it is impossible to time the market. A bull market can turn into a bear market very quickly, and vice versa. For example, during the 2008 financial crisis, the S&P 500 entered a bear market in a matter of months, with a sharp decline in stock prices. Changes in the real estate market are more like a cruise ship taking a U-turn. You see the signs for a long time, and eventually it turns.
Welcome to Personal Finance Cat, where I share my personal take on personal finance.
I remember listening to a podcast episode by The Bigger Pockets, where the guest spoke about how he saw the signs back in 2004 and started to exit in 2005-2006, a couple of years before the 2008 crash. And the story gets better. After 2008, he started buying again, sometimes from the same people to whom he sold right before the crash. There are certainly debates about whether a real estate crash is really coming, or this time around things are different. Nobody has the crystal ball, but my bet is that a major one is coming. Maybe not as bad as the 2008 crash, but something big. I talked about my prediction in my very first video I made on this channel. Feel free to check it out. Besides the Harvard study about the real estate cycles I cited in the other video, I also recently came across the S&P Case-Shiller U.S. National Home Price Index, which tracks changes in the prices of residential homes in the United States over time. It is clear to me that the affordability of housing has gotten to a point of unsustainability. It is just a matter of time before the direction of the wind is going to change. And I'm not alone in my thinking. As we navigate through a complex economic landscape marked by high prices, rising interest rates, intense competition, and the looming specter of a recession, many investors are beginning to question whether now is the right time to exit the real estate market. As I mentioned in my last video, I have started selling some of my single-family properties. I already sold one a couple of months ago, and currently I'm under contract for a few more. In this video, I'll walk you through the various factors that made me decide to stop buying and start selling. That being said, if you are a new investor and don't necessarily have anything to sell, still keep listening, because I'm going to weigh the pros and cons of staying the course versus considering a wait-and-see approach. Number 1. High prices in real estate. One of the most glaring concerns in the current real estate market is the soaring property prices. Over the past few years, numerous metropolitan areas and even historically depressed areas have witnessed unprecedented price appreciation, making it increasingly challenging for investors to find lucrative opportunities. While high property values may seem like a win for property owners, they can be a major deterrent for new investors looking to enter the market or those seeking to expand their portfolios. The allure of real estate investing has often been driven by the potential for substantial returns. However, rule number 1 of real estate investing is that one shouldn't count on appreciation, because nobody has the crystal ball. The 2008 housing market crash should serve as a constant reminder that big price corrections could happen. Therefore, when you try to get into real estate as a buy and hold investor, the numbers you should really care about are the net income from renting out the property, but not appreciation. There are many sources from which you can learn how to do that. Anyway, my point is that these high prices can erode the profitability of investments. Consequently, investors may be questioning whether the returns justify the substantial capital required to secure properties in today's competitive market. All that being said, real estate is a hyper-local business. The general trend does not necessarily match what is happening in your market. As a new investor, if you still can find properties for which the numbers work, then by all means, snatch up those deals. It may just be much harder to find them nowadays, but they may still exist somewhere out there. Number 2, rising interest rates. Another significant factor causing me and other investors to ponder an exit strategy is the upward trend in interest rates. Historically, low interest rates have played a pivotal role in bolstering the real estate market since the Great Recession. However, with the Federal Reserve's shift towards tightening monetary policy, Interest rates have started to rise, and it most likely will not change course in the short term. High interest rates translate to increased borrowing costs for real estate investors. This can impact the profitability of investments, especially for those who heavily rely on leveraging their properties, like myself. As interest rates continue to climb, the margins for real estate investments may shrink, making investors more hesitant to commit. Again, on the flip side though, if you can still find a good deal where the numbers work out, then that deal will be a great deal once interest rate comes down and you can refinance to a lower interest rate. Number 3, intense competition. Real estate has long been regarded as a competitive field, but the current landscape takes it to a whole nother level. With high demand and limited supply, multiple bidders are often vying for the same properties, driving prices even higher. This heightened competition can result in investors feeling pressured to pay top dollar for properties, potentially compromising their investment returns. For whatever reason, recently I also see many investors reinvent themselves as multifamily syndicators. These folks may have previously been in the single-family or small multifamily space, or flippers, but now they're all jumping into the large family syndication game. The cap rate as a result has been compressed so much, making me wonder whether that's a sign for getting out. If you don't know what cap rate is, it's basically the cash return you earn from the cash you put in. Let's say you put in $100,000 to buy a property or buy into a syndication deal. Each year, the cash flow is $10,000. Then your cap rate is 10%, which is 10,000 divided by 100,000. I used to look for deals that are at least offering a 10% cap rate. Nowadays, it seems that the cap rate is below 5%, partly due to the intense competition in this space. Therefore, finding good deals that can withstand the overall economic downturn may be almost impossible. More on that later. Lastly, the influx of institutional investors and real estate investment trusts, or REITs, into the market has intensified the competition. These deep-pocketed entities can outbid individual investors and secure properties at premium prices, leaving small investors with fewer viable options. Number 4, the pending recession. Perhaps the most ominous cloud looming over real estate investing is the potential for a recession. Economic cycles are inevitable, and many experts believe that a recession may be on the horizon. When economic downturns occur, real estate markets can suffer. Property values can decline, rental income can become less predictable, and vacancies can rise. Going back to the large multifamily syndication deals, why are these syndicators still putting deals together even with such a low cap rate? Well, the reason I think is that a lot of the syndicators are counting on the sale of the property through forced appreciation 5 to 6 years down the road, so that they can still deliver a good return to the investors. But still, it's risky in my opinion, even though I understand that multifamily properties are less subject to comparables, since their valuation is all based on income. Their valuation is still going to be impacted by the general economic downturn. When people can't afford to pay rents, it may force the rents to come down or vacancy to go up. In other words, if you're counting on the appreciation through higher rents and or lower expenses in order to generate the return you promised, that may or may not happen when the economic condition goes south. The pending recession is going to have an even greater impact on single-family and small multifamily properties, because these properties' valuation does rely on comparables. When foreclosures, short sales, and motivated sales become commonplace due to the recession, lowered sales prices of these comparables will likely drive down other properties' value as well, causing an overall decline in real estate prices. Conclusion. Given these factors, I have made my decision to stop buying and start selling. However, as I said earlier, it does not mean that an aspiring investor like yourself should follow suit, because there could still be good deals out there. It may be a lot more difficult to find them because of the various factors I just spoke about. As the author of The Millionaire Next Door puts it though, and I paraphrase it here, you will never grab the good opportunities if you are never in the game to begin with. Before closing, I do want to share some strategies that can help mitigate the challenges posed by high prices, rising interest rates, intense competition, and the prospect of a recession. 1. Diversification. Investors can consider diversifying their portfolios by exploring alternative investment opportunities such as stocks, bonds, or other asset classes that may be less susceptible to real estate market fluctuations. 2. Stress testing. Evaluate your real estate investments under different economic scenarios, including a recession. Stress testing can help you identify potential vulnerabilities in your portfolio and develop strategies to mitigate risks. 3. Consult with experts. Seek advice from seasoned investors who have experience through various market conditions, and their insight might help you make informed decisions. Number 4. Long-term perspective. Real estate investing has rewarded those with a long-term perspective. If you believe in the growth potential of a particular market or property, it may be worth weathering short-term challenges. Hopefully, this is helpful information. For me specifically, I'm also embarking on a new journey to focus more on my YouTube channel and podcast, as I hinted in some other videos. And I'll take a back seat in real estate investing. Why? I'll explain that in my next video. Thank you for watching until the end. See you next time. Happy investing!